This is our Forex blog for September 23rd, 2013, and this is the easiest way to trade. Basically, you look at the currency indexes, which show each individual currency. Here's the dollar, the euro, the pound, the yen, and you find the strongest one, and you buy it versus the weak, or in the case of the euro, which is on top of all the other main pairs, you sell it if it's weak versus whatever one's strong on the bottom. So we have a weak euro, strong yen, and basically you want to use our FX trade signals and focus on sells. So we got, sell here, put your stop a pip or two above that entry bar's high, so you're risking 5 to 8 pips on every trade. You can see that one worked. This one came down a little bit. You would have probably lost 4 pips on there. This one, fell 20 or 30 pips. This one you lost 5 pips. You made 20 there. You made 15 here. You probably lost 3 or 4 pips here. You made 20 here. Counter trend trade, we're very selective. We basically trade with the trend until the market moves statistically too far. But when the trend's down a significant amount, we're basically focusing on selling. And the deeper the pullback, the better. Once this trend begins, here's a decent trade. Here's a decent trade. Here's a decent trade. This is a decent pullback. Decent pullback. Decent pullback. Not all of them work, even decent pullbacks. But if you get a decent pullback off of the previous swing low, this isn't much of a pullback. The market was statistically weak enough to potentially go down, so we put that trade up there. This is a decent pullback too, because the market was trending down. Decent pullback, decent pullback. So if you just eyeball and take the trades that are highest probability, you basically just want to focus on trading the weakest versus the strong. Now you can see here the pound was also quite strong. I'm just going to bring up a 5-minute chart here. Euro pound. Weak euro, strong pound. It's very likely to go down, especially when it's above its hourly moving average until about 10 o'clock. You're focusing on selling the euro pound. And you can see a little breakout of the little sideways rectangle right here. Decent pullback. That's not much of a pullback. Here's a okay pullback, okay pullback, okay pullback. This isn't much of a pullback, but it did go down. If you just just have a little bit of common sense and just wait for a decent pullback in the currencies that are strong versus the weak, that's how you use these tools. Of course, what I'm looking to do with our FX trade signals is to just kind of give you a chart that looks at all the statistics of what currency's strength or weakness is. It looks at the previous swings up and down, and so when the market, here's the previous low, makes a lower low, our systems basically are looking for sells, with decent sized pullbacks. That's not that much of a pullback. These two are. The first one failed, the second one worked. This is a pretty decent pullback from the lows. It's up about 18, 20 pips from the low. Decent pullback, not a decent pullback, decent pullback. I mean, kind of common sense. And our counter trend signals are so accurate that, when you're short, if you see a counter trend trade buy at the lows, you might want to consider getting out of your trade. And you might also want to learn how Fibonacci profit targets work and look to get out of those trades, when the market hits the Fibonacci profit target level. This previous swing, I usually don't use fibs less than 25 pips, but you can see it when it hit the 1.618 fib target. I'm sorry, let me draw that correctly on here. It came within a pip or two of the 1.382 fib target here, and you got a reversal. So it's a pretty high probability place of, it would have very likely reversed somewhere in this zone down here. So you get a counter trend buy signal right here. You already got 20 pips on that trade. Get out. And fib targets are an excellent way of getting out of these trades, especially if you see buy signals at the fib targets. So this one came, down within 4 pips of the Fibonacci profit target. Ran out of steam. And anytime the market comes down, makes a low, comes back up, comes back down, can't even go lower than that low. If you get counter trend buy signals, as long as it's above the swing low, which is right here, there's a pretty high probability. And you can see all 3 of them, bounced a little bit to the upside. And as far as I'm concerned, as long as the FX trade signals go at least 1 bar my way, what I do is, when I'm manually trading these, I'm in right here. My stop's a pip or two underneath the low. Once it goes up 1 bar my way, I'm moving my stop somewhere in the middle of this bar right here, because typically that's where, if it comes down and stops me out here, it's going to go down lower, and I'm going to lose 4 or 5, 6 pips more. Might as well only lose 3 pips on the trade. So if you do that approach, and you look at how accurate our signals are, occasionally you're going to get stopped out. Here's a trade that went your way. Your stop's up here. You wait for a close above that bar. It never really closed here. I would still leave a hard stop up here. And that way you can avoid a little bit of a pullback trade like this and still catch those big wins. But most of the time, you're in. Here's your stop. You move your stop down. You got a nice little trade here, and you can just kind of eyeball and draw your exits right over the bar. If you're short right here, you're out. You're long right here. Now the first bar went down, so I'm a little bit more cautious on here. I want to wait for a close underneath here. Kind of goes up here, and I'm moving my stop up, and I might have got stopped out somewhere here. Another entry right here. We would have had pretty much a small win, a loss, and then a decent sized win right here. And you can see here it went up. We got into the trade, closed down, went up. Anytime that happens, I'm a little, pretty cautious. This bar made a higher high. I'm going to put my stop here. And so on a trade like that, I'm going to lose just a ridiculously tiny amount. And when you factor in all the big wins like this, where you probably made this much, you made this much, you made this much, you made, very likely this much. When you have wins that are, 2, 3 times bigger than a lot of your losses, and when you're right more than you are wrong, you're going to do pretty well trading. You can see most of these signals, because I'm up to about 80 of them right now. I look for 80 different rare patterns. Some of them are Fibonacci, double tops, double bottoms, hourly moving average trades, for instance. I think this one right here is an hourly moving average. If you put the containment bands on here, which show the hourly moving average, I think that's what that particular trade is. It is, yeah. So the market's trend is down. It comes up near the hourly, has a reversal pattern, very likely to be continuation. And sometimes this trade right here it's not going to go any higher than that, and it's going to fall 30 or 40 pips. So we have to take every trade in the chance that we're going to catch a 20 to 50 pip trade. Today was a pretty low volatility day. If you look at the high minus the low, we're around 40, the low's around 80. It's a 60 pip day, and if you added up every move minus, the losses, we probably caught 40, 45 pips out of that 60 pips, because of the swings, and including the losing trades too. So that's how you use the currency index. You want to buy the strong versus the weak, sell the weak versus the strong. You can see the dollar was weak. Obviously the pound and the yen were strong, so we'd be buying pound dollar, especially earlier in the day. Goes up, buy the pullback, goes up, buy the pullback, goes up, buy the pullback, goes up. And then dollar yen, dollar's weak, yen strong, it's going to go down. Goes down, sell the pullback. Again, wait for a deeper pullback and you'll avoid a lot of the losses. This is a decent pullback, this one isn't. And the market kind of goes up a little bit and goes sideways and goes up again, decent pullback. Comes down, decent pullback. This one's not a decent pullback even though it worked. That's not a decent pullback even though it worked. This is a decent pullback. So just have a little bit of common sense. I probably would have taken this trade, not that trade, even though it might have given me 3 to 5 pips. This trade didn't work. This trade worked. I'm not sure if I would have, taken this trade either because of the time of the day. So it's that simple. Have a little bit of common sense, use our currency indexes, and focus on trading with the trend. And when the market goes statistically too far, you look to do counter trend trades. For instance, I'll show you how to do that real quick. The euro, way underneath the lower 2.0 white band here from 9 to 12. So it's likely to get a bounce. Which currency maybe is up too much? Well, the yen right here hit the upper band. It's likely to pull back a little bit. The euro is likely to get a bounce. And of course, the yen also happens to be where the trend channel would be. If you draw your trend lines off the low and you project it off the high, there's so many different ways of anticipating trends. So we had 1, 2, 3, 4 touches on the bottom, 2 on the top. This is a very likely place to reverse. If you look at the Euro-Yen chart at 11 o'clock, you look to buy the lows. What do you got here? You wait for a trend line break, from here. Maybe again a little bit later. If you're a really aggressive trader, when you see it comes down, goes up, comes down, makes a false breakout off the lows, you might actually get in right here with your stop underneath here. You can see it went from 133.20 all the way up to 50. Nice 30 pip counter trend trade. Pretty amazing. And of course, if you look at our actual chart here, we had a counter trend trade a little bit before that. Typically when you start getting counter trend trades on the range charts, a lot of times they're a little bit early. You can kind of look to buy the next pullback lower, especially when it comes back above the previous swing low right here. And so you're in somewhere around 11:30. And I wouldn't have taken this short right here because it's very likely to get a bounce. And you might have got out of your trade here with 8 or 9 pips. And I might have avoided this trade too, having looked at the currency indexes. So with manually trading our signals, you can do better than the signals do themselves by analyzing, where each individual currencies are at their containment bands, whether trend line's broken, whether it's going sideways underneath the low here. If there's buying here, it's likely to go up because it's down statistically too much. It's that simple.